You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
Welcome back to the Advisor's Option, the program here on the Options Insider Radio Network, where we break down all of the amazing option strategies and techniques that we utilize quite a bit here in the options market and tell you, the busy financial advisor, how you can implement them into your practice, as well as for all of you out there who are perhaps looking for a financial advisor, some of the knowledge, some of the weapons that they should bring to the table from an options perspective. My name is Mark Longo from the optionsinsider.com, as well as from the aforementioned Options Insider Radio Network. 13 programs on the network, including many, many archived episodes of the Advisor's Option. And where can you find all of that great, great options-oriented programming? Well, of course, the mothership, the flagship, theoptionsinsider.com, as well as iTunes, Stitcher, AHA Mobile. Tune in. If that's all too much for you, just grab our Options Insider Radio Network mobile app, available for iOS, Android, even the burgeoning Fire OS. So no shortage of ways for you guys to download or stream the content. And of course, when you're listening, after you're listening, send us your questions, your comments, your feedback. We love to hear from you. We'll make sure we get to some of your questions in a little bit on the show. But as you can tell, we sound a little bit different on this episode because we're a rare opportunity to be in the same room together to actually do the program. Usually we're beaming in from all different parts of the country, indeed the hemisphere, usually, when we're doing this show. So it's kind of fun to all be in the same room. And I am joined, as always, by my co-host here on the program, Mr. Randy Swan from Swan Global Investments. Randy, good to see you. Good to finally be in the same room with you here.
Actually, it's great to be here. I feel like I'm a regular now at the Fontainebleau Hotel in Miami. Our firm just celebrated our $2 billion of assets under management a couple months ago, and we had a firm party here. So it's good to be back. As always, the sights and scenes are rather beautiful.
Well, congratulations. That's a big milestone, certainly worthy of celebrating. You know, we know a lot of people in the options-oriented fund space, and we know how hard it is to get investors for that. So reaching that milestone is certainly worthy of celebration. We're also joined by a newcomer to the program here. He is Pat Stiefel, the Director of Trading over there at Swan Global Investments. Pat, welcome to the program.
Thanks, Mark. It's good to be here. Thanks for having me, and always love to talk about options. So if the listeners can participate in the conversation, it's great.
And since it's your first time on the program, why don't you go ahead and really quickly give our listeners a little bit of an overview of your background in the options markets and how you found your way over there to working with Randy.
Sure. So, I came out of school in '99, really interested in math, but kind of stumbled into maybe clerking, filling some stock orders up in Chicago. And through contacts in Chicago and trading a book, I was able to get some experience on the floor. And then really just became a market maker and a risk manager on the floor. Moved upstairs where the liquidity moved to, and did that for about 9 years. It was a year and a half ago that Randy and I met through a mutual colleague. And they, as the AUM was growing at Swan, it was important to staff up. So it was a really good opportunity for me, and my family jumped on the opportunity to move to rural Colorado, which is amazing, the weather, the outdoor sports. So glad to be at Swan, and with the way we're growing, I don't think the team will stop with me, or I think we're going to grow for a while.
The market-making track through the SIBO, I'm certainly aware of that track. A lot of guys in Chicago have cut their teeth on the pits of the SIBO, so it's good to see more SIBO flavor infecting the Swan folks over there. Always a good thing. And, of course, listeners, we are joined by a great guest, so without further ado, let's get right to it and dive right on into our interview segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
Welcome back to our interview segment. Like I said, we're very pleased to welcome a guest live here today from, actually, there's a financial advisors forum going on. Our friends over at the OIC are putting on right now in conjunction. We're, of course, down here at the Options Industry Conference, but in the same building. The OIC is also putting on a financial advisors forum and getting a lot of great guests, a lot of great data, a lot of great surveys. It's one of the reasons we partner with the OIC and OCC on this show, because they always bring great surveys to the table. And I'm proud to bring on and welcome on now one of the authors of their most recent study. He is Thomas Miller, the professor of finance and the Jack R. Lee Chair in Financial Institutions and Consumer and Finance over there at Mississippi State University College of Business. Thomas, it's a very, very impressive, very dense business card. Welcome to the program. I'm glad we can have you on.
Well, thank you, Mark. It's great to be here.
And like I mentioned, you just are fresh off presenting your study at the Financial Advisors Forum. And I really like the stuff that the OIC commissions and you guys get to work on, because they're real-world practical studies of how these strategies perform in the real world. And that's, at the end of the day, for our audience, for our users, I know for guys like Randy over here, this is data that is of use for them. They can go out to a client and say, hey, look, this is not me talking, this is just pure empirical data showing you how these strategies perform. So let's get into it. Your study, of course, was called The Performance of Options-Based Investment Strategies, Evidence for Individual Stocks during 2003 to 2013. So the title explains a little bit of it. Why don't you go ahead and give us an overview of your study, your methodology, and some of your key findings?
Okay, sure, Mark. First of all, this is a co-authored work with a longtime friend and colleague of mine named Mike Hemler from the University of Notre Dame. He and I have been working together since 1992 on various projects and whatnot. And my introduction to options was when I was a graduate student at the University of Washington, did my doctoral dissertation on European put call parity, actually, violations of European put call parity. And Mike had come out to give a talk at University of Washington, and we became good friends. I've subsequently written a textbook on derivatives. It was a one and done with Dave Dubofsky, who was at Texas A&M at the time. Now he's at the University of Louisville. I was actually a retail commodity futures broker for 3 or 4 years, and we cleared Cargill, and so I've had a long time interest in the derivative securities area. And so the OCC approached Mike and I about perhaps working on a study looking at these various options strategies, options overlay to a long equity position. So if we add, the covered call obviously is one of the strategies that's widely used, and to flesh that out, we put on a collar as well as a protective put, and then adding a short put to your covered call gives you something called a covered combination. And so what we did in our study is we looked at 10 individual stocks. Most of the studies that look at options overwrite strategies or buy right strategies use indexes. So we used, one of the novel aspects of our study is to look at individual securities. So we picked 10 stocks, and they're very familiar, Apple, Amazon, Google, Microsoft, and others that are linked on the OIC
most
website.
Advisors out there probably have.
Yeah, well,
accounts.
yes. In fact, they're the 10 most widely held in 401k plans as of 2012. So we went and back tested these different strategies over from 2003 to 2013 to see what strategies perform best. And in a nutshell, what we found is the covered call outperforms long equity, and the covered combo outperforms the covered call, actually. And the long equity, though, outperforms the caller and the protective put. And we looked at measures, we would rank the performance of these strategies across different equities, across different time periods. And so when we ranked the results, we found basically this is a pretty robust finding that the covered combination tends to do better than long equity. And so we advise in our study, though, that we look at standard measures of risk-adjusted performance measures, the Sharpe ratio, Trainer, Jensen's alpha, and those measures actually depend on whether the returns are normally distributed and whether investors only care about mean and variance standard deviation. But we know that that's not true. We know that there's skew exists in the world. People do prefer some skew. So that's one of the caveats that we have in our study is that Hayne Leland in 1999 put out a paper and he talked about this. He predicted, in fact, that covered calls would tend to beat long equity because of just this critique he had. So he has his own measure, and we implemented it to see whether it would change the rankings, and it does not. So it's robust to that. With individual equities, we have to worry about early exercise. And so we have the luxury of looking back in time, and we looked back in time and found that, for the short calls, you'll get exercise if somebody is going to capture a dividend. And we just didn't see that in our sample because we were using near-the-money options.
My question is it standard across all the strategies, like a 3% out of the money call every time and a 2% out of the money put or something along those lines?
It was, we picked the closest option to 5% out of the money in every time period. So what we would do is we would start a horse race where every month, at the start of the month, we would put on the strategy and have the long stock. At the end of the month, we'd close out the option strategy. So, for example, for January, we would look at February expiration. And so we wouldn't be into the expiration period. We would close out January 31st, roll it over into the February.
So you're never getting stock called away in any of these hypothetical scenarios, which I think is important for a lot of the advisors out there who, for whatever reason, don't want that stock called away. They're fiercely protective of that.
But we did see sometimes, yes, in our sample that we did get some called away, but very infrequently. It's less than 1% of the time.
Variant dividend or something like that.
Mm-hmm. Mm-hmm. So anyway, we feel that this is kind of a novel study in that we do use individual equity options, and we run 4 different strategies. Most academic studies look at one strategy on an index. And so it's kind of groundbreaking in that respect. And we have good feedback here at the council on different questions from the industry on, have we tried this, have we tried that? And we say, well, we're academics, we're just trying this first attempt at it, and there's always other studies to do. I mean, it's one of the questions we were asked today, in fact, is why does our sample stop in 2013? Well, the answer is that it took us a year and a half to write up these results and do the analysis because we have to make sure that we're accurate and that we check and double check and our results. Otherwise, we don't want to appear to be haphazard. But it does take time. In academia, we measure things on a glacial scale. So
Yes.
a year and a half is pretty fast, actually.
Well, I'm curious, how involved was the OCC, OIC in the study? Did they help you choose the strategies, or were those all your decisions? Particularly the covered combo. You don't see any data on the covered combo pretty much, or the covered string, whatever you want to call it, ever really.
Well, actually, Alan Grigoletto from the OIC urged us to look at the covered combo. And so we're the first study to actually do that. And it came to us from Alan, actually, at the OIC. So he prodded us, and then we looked at the literature and said, well, there's covered call, and we thought, well, we teach protective put to students, and the caller, Bernie Madoff and his split strike conversion, and all you got this caller anyway that we can look at too, and so we just stopped there. Now, a lot of advisors might be thinking, well, with that covered combo, you're leaving yourself open to that put. You're short a put, and a lot of our back channel talking here at the conference, people will buy a like a 15-point, 20-point down put to hedge against a disaster. The old saying is, just live to trade another day, and so, but we don't implement that in our strategy. We're open on that covered combo, and the results are available at the OIC website. But basically, we find that the covered combo outperforms the long equity in lots of different ways. We look at these different risk-adjusted performance measures. We look at cumulative returns. And then we divide the world into sub-periods, do all the typical academic, slicing and dicing, and it's just a pretty robust result, actually.
It's important to note, too, that time frame is not just all bull market. You have the '08 meltdown in there. So there are some very periods where being a short put may not be the best idea,
right.
And it's all factored into that data. So I think it's important. People will say, all these studies cherry pick time frames, and it's all in the bull market, and that put's never going to come into play. It came into play a few times, I would wager.
It sure did, and actually the crisis is kind of right at the dividing line in our sample, and so, but these strategies seem to perform the same for the early part of the sample, 2003 to 2007, or 8 to 13. So it's robust to that.
It's interesting. I know the guys at the OIC. I know obviously Alan's been on the show a number of times. I know the kind of covered combo, covered strangle, whatever people call it, a bunch of different things. I know it's been one of their kind of strategy they wanted to look into for a long time. I know they tested the waters a few years back, I think asking some advisors would be interested in this. And exactly what you said, the short put leg scared the heck out of everybody. And they said, wait a minute, no, we can't touch that. We have a short leg. And so I think they kind of put it off. But I'm glad to see they finally got a study, because exactly what we're talking about now, having some data in your back pocket kind of arms the conversation.
Yeah, I mean, I'd just like to add that I love the study. We use it a lot, obviously, in our day-to-day, discussion of what we work with at Swan. We always look at having the put part of that as a big component of our ultimate profit in the strategy. So we always laugh and say, that's where the money is. Why do you sell puts? That's where the money is. So as far as I'm concerned, I love that concept. I just wanted to confirm with you, Tom. So the strategy in terms of selling the options was, even though you were holding longer than you held it a certain fixed period of time, so basically on a monthly basis. But other than that, there was no active management in the actual options, and that's to keep it very standardized. Okay.
That's correct. It was just a very mechanical, put the option strategy on the first trading day we can, assuming we get filled at the bid-ask midpoint of the options for any size that we're doing, of course, and there's, that's a heroic assumption when you're actually trading options, but it's mechanical. At the end of the month, we take it off, roll it to the next
let me ask you a big broader question. This is the actual single most asked question of us when we're out presenting our strategy and our concepts of what we're doing is, where does a strategy like that fit into a portfolio? And I think that, quite frankly, listening to the speeches and talks this morning, I think, quite frankly, that the group of people that are doing these types of strategy are shortchanging themselves. I think that the application of a strategy like these are are much more valuable than most people give credit, as opposed to getting, maybe a sliver of a portfolio. I think they're much more powerful to manage risk on the entire portfolio, which is what we've done at Swan for now almost 18 years. So from your academic perspective, when Morningstar did a write-up on our mutual fund, they actually said, hey, could be a replacement to the traditional 60-40 portfolio, which is exactly what I wanted to hear. But I wanted to get your perspective of, is this just a little individual allocation to your portfolio, or how, if you were looking back and saying, how would you plan a portfolio knowing what you know now?
Well, on our study, we're overlaying the entire portfolio. So we're saying if you own whatever shares of the underlying you have, you're overlaid 100% on your portfolio.
Right, but I'm saying in the relationship of some of the speakers today are talking about, we have this part of a program at this firm, and it's a covered call program, and of course you're going to build that as part of your entire portfolio. And so at Swan, we've really been more of this is the solution to the problem of, modern portfolio theory really doesn't protect against market risk, or, 2008, it really proved not to deliver the results that I think most people wanted. We really believe that, we generally are used as a core in someone's portfolio as opposed to just an alternative strategy in a bigger picture. And so, our thesis was always that if you can manage risk on a larger part of your portfolio, that's more valuable than just saying, hey, they're going to get a 5 or 10% allocation at the end of the day. I mean, you ultimately found and agree, I hope, that you're getting a better return with less risk, which of course is great to a strategy.
Well, the risk part is hard to measure, though, right? I mean, it's in some sense, because we really don't have a way to measure risk of option strategies precisely. It was our point in our paper, but then again, long equity is a risky position. So we're just saying, compared to holding long equity, if you overlay the covered combo or a covered call, they just do better.
Right. So you're saying, Randy, this shouldn't be just limited to the alternatives ghetto of the portfolio, that 5 to 10% where you try some crazy stuff. This really should be suitable to the entire portfolio.
Right. Well, I go back to the analogy. I always tell this joke when I give a presentation. I go back to going to the dentist one time and talking to the hygienist, and he had a patient ask the hygienist and said, what teeth should I floss? And he said, only the teeth you want to keep. And I always use that to this portfolio. Which part of the portfolio belongs using a hedged strategy? And I said, the part of the portfolio you want to protect. Right. So the difference obviously between what your study is, which I love, as I said earlier, we're a little more active in the management on the individual option trades. So when you talk about selling puts and calls, one of the value adds we think we do at Swan, and I'll introduce Pat here in a minute, but we think that there's some value in the active management of the individual income trades that ultimately prevent that selling that put in a year like 2008 to really give up several years of gains. So we always come back to, from more of an underwriting perspective of how do we think we can make money over and above whatever risk premium may exist in the market by having certain rules and guidelines to manage those trades.
And you guys typically don't have the short leg to the downside. Usually you do a spread, right?
We do a spread, but what we really do is to maintain the integrity of buying a put to protect the portfolio. We always look at our income trades as separate component. I mean, they work together obviously, but at the end of the day, we're trying to actively manage the strangle effectively in our strategy, and whatever spread orders we do separate from that to say, look, if the market drops 20% during that quarter, we would have been long out of that short strangle position or made several adjustments along the way to ultimately have a put position in a year like 2008 where the put really does provide a lot of put protection or value to the portfolio, as opposed to just saying, hey, we're going to sell an out of the money put and we're going to buy an at the money put and it's going to give us some level of protection. We want all that protection at the end of the day.
And Pat, you're the guy out there, rolling the puts and actively managing the puts. What's your take on this study and these findings?
I really like the study, and there's two things that I really like about the study. One is that the repeatable nature of it, okay? The following rules, all right? And that is not just good for academia, okay? That is important for portfolio managers, and I'm sure advisors struggle with this, right? Their client wants to react, and the client needs to be advised to trust the process and the long-term nature of the markets, the full market cycle, as we talk about at Swan. And that speaks to the second point, is that the reason many investors cannot do what Tom would advocate with the covered combo, for example, and where as you heard Randy say, we actually, our theory, and we have results, is that makes sense. It speaks to the robustness of what they have represented here. And clients will inevitably sell that put, for example, and then 08 will occur. And near the end of 08 and early 09, they will say, you know what?
I'm done with options. This is terrible.
And we know that's the time, the end of 08, early 09, all of 09, right after the credit downgrade, right after the flash crash, that's the time to sell options. That's the time to sell puts. We shouldn't do it haphazard. But we have a rule in place already that forces us to sell puts, forces an insurance company to write premium after Katrina comes through, when the customers are willing to pay more premiums.
Well, Tom, one other thing you mentioned here that kind of perked my ears up. I know you mentioned the collar, the long equity in your findings, this outperforms the collar. And that was interesting to me because I know OIC, previous, a lot of their studies have been around the collar. And they've studied collars on a variety of different products, commodities as well as Russell and some of the broad equity indices. But you, of course, in your study did it on individual equities. I know the findings of the earlier OIC studies were that essentially the collars performed comparably or sometimes outperformed on a total return basis and certainly on a risk-adjusted basis. Sounds like your findings were a little bit different on the individual equities. Can you break those down a little bit for us?
Sure. The collar came in basically fourth on the race. I mean, it beat the protective put, but that was the only. It didn't beat.
You would hope it would beat the put, otherwise you're doing something really
exactly,
wrong.
Exactly. And that's the other. That's why we have the protective put there in the strategy or in the papers, just so that when you get results, you have to ask yourself, does it make intuitive sense? And if you can't beat the put, it's like, geez,
like, what are you doing?
But we do find, though, that when you look at if we look at just the comparing them, the mean, if you subtract the mean of the long stock from the mean of the portfolio of the option strategy, and then look at the standard deviations, do the same thing, that the collar actually has a lower mean and a lower standard deviation. So it is like you'd think. It has that. You've knocked the tails off, yes, basically, and it does show that in our results. But in terms of just the rankings, and when you're running this horse race among the strategies, the collar just comes in behind the covered call.
Tom, isn't it possible that you can use the standard deviation and the variance of returns to come up with some more risk measurement metrics as opposed to raw return, risk-adjusted return?
I'm not sure I quite follow you, Pat.
So if you're delivering the same return with the lower standard deviation, I would argue that it is a better risk-adjusted return.
Oh, I hear you. Okay.
And if it's a lower return, then it is tough to measure.
Right.
And Sharpe tries to address some of that.
Right.
But with interest rates at zero, the Sharpe ratio kind of goes out the window.
Well, what we're finding though is for the combo, it has a higher return and higher risk.
Okay.
On our exhibit one in the paper.
Tough to measure, but you have that in your chart there. If people do go to the website, they'll see that which chart, exhibit one. There you go. Right.
The old saying, you can't eat risk-adjusted returns, right?
Yes,
so the risk-adjusted returns are great, Sortinos and Sharps and all that is great, but if it's 1% versus 10%, the client's probably going to choose the 10% at the end of the day because they can eat. So yeah, it's interesting. But this is really great data. I'm really happy we can get you on, Tom, to break some of this down. That's, like I said, that's why I love having the OCC as part of the show, because they always come armed with great data that our listeners can take and use. And it's not some really esoteric study. It's stuff that they can use that we talk about on this show. We talk about collars all the time. We talk about, we have dallied with covered combos. Now that this study is out, I'm going to feel a little bit more licensed to do that. I kind of was reticent to do that because I think the OIC guys told me that people were scared of that strategy. But now that you have the data, I think we're going to dive into that a little more because that is a very interesting and very underreported. You see covered calls all the time. You see other things. You never see people having that put leg as well as short put legs. And that is interesting. I think a lot of our listeners may be very interested in that, particularly if they can pick strikes where they're comfortable selling and buying the underlying. Then you've done a lot of that risk management for yourself, and there's no reason why you shouldn't be doing that. If you're comfortable working a limit order in the stock, you should be comfortable doing this strategy as well. And so I think that will be very interesting for a lot of people. And Tom, anything else you want to leave us with? Any things that surprise you? Any perhaps hints of things to come from this study or related studies? The floor is yours.
Okay, well, one of the things we probably will do is go back and look at a combo with another put, but
so a put spread to the downside?
Yeah,
okay.
Maybe, but here's
just to allay some of the fears?
Yes, but here's the thing is like active portfolio managers like at Swan, I mean, our strategy is just a on-off switch. So we put it on, just gone for a month, come back, take it off. But clearly, if you're watching the market, I mean, you're going to see something developed in, say, the VIX will start giving you some signs. And so if you have a covered combo on, there's no reason to think that you can't just somehow, throw some hedge protection on there yourself. But in our academic study, we're just saying it's a mechanical trading process, so there's no feelings or emotions to come in. But based on our conversations here in Miami, we'll probably go back and look at that, adding that long put down 20 points or something.
That makes sense, just for the psychological benefit.
Yeah, exactly.
I think a lot of our, some firms, some funds may have prohibitions on having that short leg and things like that.
Definitely.
Even though, like we said, it makes sense, but you have to. It's baby steps, as we all know here, when talking options and fund managers and advisors. You have to slowly bring them in, and if you scare them out of the room with your study, you maybe need to dial it back a little bit. But this is fascinating stuff. Again, our listeners, it's all. Oh, sure. Go ahead.
Yeah, I'd like to add one more thing. Is that a lot of endowments and other pension plans might have prohibitions against margin accounts, and so. Purchasing options is something they might be able to do under the rules of their charter, but selling options maybe not. So they'd have to work through, on another firm somehow, or an ETF or something. But
well, Tom, like I said, I'm very happy we can get you on to discuss this study. If our listeners want to learn more, they can go over to optionseducation.org and click on that advisor tab there, and that's where all the good data hides, usually over there. They make you sign in, but once you sign in, listeners, you get access to all of that good stuff. I've been arguing with them for years. Get rid of that sign in, let anybody come and get it, but that's their barrier to entry. But go through that, you'll get access to all the data, including those old collar studies that I was talking about. I'd be curious myself to go back and kind of compare and contrast some of those to some of yours. I think that's very interesting stuff there to see some of the raw data. And of course, this new covered combo study as well. A lot of interesting stuff. So Tom, thanks for coming on. We appreciate you taking some time out of your day here in sunny Miami to join us.
Well, thank you, Mark. It was great, and it's great to see you guys, Randy and Pat. We saw you earlier in the week, and it was great to see you again today.
Absolutely. Look forward to conversing with you guys in the future.
Terrific.
Congratulations.
Thank you.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
Welcome to the Buzz segment. Of course, this is the portion of the show where we break down all the interesting happenings in the world of options. So you guys, the busy advisors, don't have to. Of course, I'm sure more than a few of you, if you're tuning into this program, are maybe at the event we're about to talk about. Of course, the big advisor forum going on right now here today, here in sunny and scenic Miami, Florida. And Randy and Pat, I've been unfortunately locked away in this room recording. You guys have had a chance to actually go down and check it out. We just had Tom on. Of course, he had some really great studies that he was talking about at the conference. But what else have you seen that's been kind of interesting and compelling for our listeners you'd like to share?
Well, Mark, I guess one of the things that we talk a lot about on this show is the educational process and in getting acceptance of options in the investment community. This has been a long process that I know that, of course, I've been working on for almost 20 years now. So I guess the good thing I'm glad to report on is it seems like there's a lot of firms out there just in this conference alone that are actually developing product and developing the processes to offer similar type strategies in their conference. Now, I think, quite frankly, they're being a little too cautious I still think that the value of strategies like this are much more broad and should be a much more bigger part of your ultimate portfolio solution. But it's great to see these guys actually embracing some of this stuff, and it just shows you that demand, I think, is absolutely there. So I guess I would just say that it seems like there's a shift going on. I know it's been going on for a while, but the fact is that if multiple brokerage firms out there are talking about offering covered call strategies or programs they're setting up for their clients, I think that's a pretty good sign that the acceptance is occurring. And I would just add that it's a good move, because I do obviously believe in the value of introducing options into the portfolio for risk management purposes, as well as income generating strategies in this low interest rate environment.
That's really great to hear if that's indeed the case, because that's something this program was created to combat. In many ways, the guys from OCC came to me years ago and said, "Hey, we have this problem. This space is uniquely suited to using options, and no one is doing it. What can we do to help reach out to these guys?" And so the fact that they have these events, they do this show, and all the other outreach that Eric and Alan and you guys do as well over there at Swan, it seems to be finally taking root and taking hold, which is good to hear. It's not often you hear someone, like in your case, Randy, excited that more people are coming to play in this space and essentially be competitors. But I think you realize that a rising tide lifts all boats. It's good for everyone to see more people getting into this space. So that means the acceptance is there. You guys will have less of a hard time, when you go knocking on doors saying, "Hey, we use options." They won't be that slammed in your face the way it was 5 or 10 years ago,
We participated last summer in a Morningstar interview process, and Jamie Atkinson, our national sales director, he went through the presentation, and he asked these guys, do you guys see a lot of strategies like ours? And he goes, "No, we don't have any strategies like you guys." And he said, "Well, there's a good side and a bad side. The good side, no one else is doing it. The bad side, no one else is doing it." So yeah, we generally like competition. We want the industry obviously to grow, and because of our longevity, our track record, and our successful performance since inception, we obviously we're happy with that pie getting a lot bigger, and so we're pretty enthusiastic. And so just from a more fundamental perspective, like I said, I like a better mousetrap, and I think option strategies are that mousetrap.
Pat, has that been your takeaway from the conference so far as well? Are the options getting more broadly embraced in your view?
Absolutely. Obviously, growing the pie in your industry helps everybody. I think, from my perspective, having been on the front lines for a number of years, and Randy was hammering away on the front lines for a number of years. He's still actively involved in the trading we do as a portfolio manager. We think of it as competitive, and the market maker versus the broker, or a market maker versus another, even an advisor versus another, and the quality of their portfolio. That will not be good for all of us in the long run. And I think we need to continue to remind ourselves that although some people may say options is a zero-sum game, they are connected to stock. They're overlaying stock portfolios with other commodities, and other people have other assets, real estate and whatnot, in their portfolio. And real estate, stock, the general economy is not a zero-sum game. In fact, as we all know with the way the government runs their books, it is very important that our economy grow always, the entire Western world. So if options are connected to that, then options do not have to be thought of as a zero-sum game, and we can all win. I know it sounds like we all hold hands and say kumbaya. It's not that. It's we all make more money. Our clients all make more money. We all live better lifestyles, and it's just better for the Western world as a whole.
It's funny you should mention Morningstar, Randy, because one of the eye-opening moments I had right before we launched the show, maybe within a year before we launched it, I went to the Morningstar Advisor Forum they have every year in Chicago. It's a huge event, takes over all of McCormick Place, where if you're not familiar, Chicago is a very large convention center in Chicago. Row upon row of funds showing off their wares, panels, sections. I went to all of them. They had one, that's why I joked about the alternatives ghetto. They had one alternatives panel amongst dozens, and it was all about managed futures, obviously, which struck me as odd. They would embrace managed futures, nothing to do with options, nowhere. I saw funds there marketing themselves as volatility funds and income funds. I would approach them saying, "Oh, you must use options to generate income or to manage volatility." "Oh, no, volatility, it's all about defensive stock selection." "Oh, income, it's high yield bond things." I came away walking away from that saying, wow, it was like 1973 from an options perspective, and that no one used them at all. It was terrifying to me, because it wasn't that long. It was a few years after the big 08-09 meltdown. So you think someone in that audience would have gotten the message by that point. Even our friends, the ISE, who are International Securities and Options Exchange, they were presenting their booth nothing to do with options. It was all their index products and everything else because they knew. They knew going to that audience, speaking options was just a foreign language to them. So that to me was eye-opening that, wow, here's Morningstar, a leading name in the advisor space. Here's a lot of the leading fund managers, asset managers, and advisors who are doing this. They're on the front lines implementing this. They actually have assets. These are not guys with 5 million. These are guys with 100 million, some a few billion, and options were nowhere to be found. And that's to me when I said, what we really need to do. We need to do something because this is you're right. This is bad for everyone. If everyone just follows the market up and then follows it back down again, and that's all those guys I talked to, that's exactly what they were going to do. They actually had a panel, believe it or not, and the whole focus of it was, well, the old diversification theory of buying about 20 different assets, that doesn't really work anymore. So we have to go to 40 now. And that was so I kind of stood up and raised my hand and I said, why don't you just buy a put? All this stuff you're talking about for the last hour is antiquated. You're chasing your tail. And they didn't respond very well, let me just say, to that. I wasn't shown out of the door, but I looked at me and kind of said, get out of here, guy.
Well, it's funny. You always have to introduce the concept that we insure every aspect of our life. Why not our portfolio? And so we always approach it from the perspective of, hey, what's the most efficient way to manage risk? A direct approach I always believe, is the best way. And we think using puts to hedge, and none of us would look at it and say, if we all insure our houses and our life and our property, that if those negative events don't occur and we pay the premium, that's a bad deal.
Yeah, you're not mad your house didn't burn down. Yeah.
So at the end of the day, I always go back to that fundamental issue. Obviously the options market largely, I think, was created for protection, and we always get into the concept of are you using options in the right manner in terms of proper leverage as it relates to the portfolio, and I think that's where some of the negativity comes in. Obviously there's some people that have done it the wrong way.
Since also this is a rare opportunity to get us all in the same room together. I know we get a little chance to chat usually at the end of every episode, but let's take a moment here now on the show too, because you guys are always talking about the interesting things you have up. You also have Pat joining us, which is we don't get that very often. So let's talk a little bit about what you guys have been up to since the last time we gathered, and what kind of things are really coming down the pike. How is the mutual fund progressing? How is some of the other products progressing? Give us kind of the catch up on Swan, if you will.
Sure. Our vision and mission for the last probably year or so has been we have created a strategy and a process that we think can ultimately be applied to many underlying assets. So whether you're talking about emerging markets or gold or real estate or small caps. So really our view has been to let's take the DRS to multiple assets. So as you know, we launched an emerging market fund last December. That's going pretty well. In this game with mutual fund, it's a lot about getting on the platforms and getting the ability to even sell your fund. But I think that's really where we're going. So our goal is still the same, as we'd like to launch another 3 to 4 mutual funds over the next year, and ultimately provide advisors and end users of products like ours choices. More choices is better. So build on the concept of diversification beyond just the S&P 500 to provide to these other assets that ultimately will help you build a better portfolio.
Do you see it like the overlay on crude, for example, and getting that far afield into commodities? Or are you still talking mostly equities and indexes for now?
Well, we really want to do a gold-based product. We are having some legal issues in terms of the way mutual funds are structured and what kind of limitations they have, but fundamentally we love that concept. I always have told people that if I could choose the 3 best assets that I would like to DRS at the end of the day, it would be S&P 500, gold, and emerging markets. We think those provide the best non-correlation. We obviously know that during times of market distress, correlations go to 1 when you don't want them to, but we like the big movement. You take a year like 2013 where the S&P was up 32 and I think gold was down 35. From our perspective, you can't have a better year than that. At the end of the day, to have movement and the underlying to allow you to lock in profits at the end of the year or rehedge and get additional shares. So we're pretty excited about the opportunities. In terms of the overlay, Pat, maybe you want to chime in. I think that we think one of the biggest growth opportunities at Swan is the overlay market, where we take an underlying portfolio or an individual stock and try to build a customized hedge. Pat, why don't you add some background?
Sure. So it's pretty funny. You heard Randy say to DRS something. So we will use defined risk strategy.
New verb. I like it.
As a verb,
the
in the same way that you would insure your house. So we do have clients that come to us with specific needs. We will meet those needs if they meet certain criteria. It has to be a certain dollar amount for it to be operationally cost effective. And it has to fit into our thinking of capital preservation with growth and income. So that is growing. That business is growing. It's important that we grow it slowly. And maybe slowly is not the right term, but that we do it right and get the right clients. You hate to say no to a client or block of clients, but as long as it doesn't take us off course, there's a number of names that I can't get into, but some people want a caller, and we have the capabilities to give them that. We would rather give them a more DRS-like portfolio.
That's what you guys are bringing to the table. That added I call it with collar with a kicker. That's what I've referred to it with Randy before.
Precisely. So when he talks about gold, when he talks about gold, and these are asset spaces, if you will, commodities, real estate, small caps, bonds, perhaps, everything should be DRS'd, including your car, including your house, and especially your investments. And, I hate to say, if you're not going to use us, use somebody else, but that we'd go back to why we're here, growing the pie, why financial advisors are finally getting back in the area where it's not a bad word. Okay, we hire a plumber to change our sink and fix that, but we will not help solicit help for our largest assets. So to me, that seems asinine. And the government needs to step in and help out and not scare people with terms like derivatives.
Yeah. There's a reason it's not called the Derivatives Insider Network, because no one would tune in a million years. It's you down at this conference. It's very much a pejorative term. The D word is not used.
It should not be. Yeah.
All right. Well, I'm glad we could check in with you guys. We got a few more minutes. I want to make sure the listeners get a little time on the show as well. So without further ado, let's check on in with some listener mail. All right, and welcome to the listener mail segment. This is, of course, a portion of the show where you guys get your chance here to take the reins. I get to take a bit of a rest. You know how to send your questions and comments in. No shortage of ways to do just that. Of course, you can surf on over to the mothership, theoptionsinsider.com. Leave a comment or a question there. Use our website feedback form. A lot of you guys like to do that. Of course, you can find us on social media, twitter.com/options, facebook.com/theoptionsinsider, or on StockTwits. We're Options Insider on StockTwits. Or you hit us up the old-fashioned way, questions@theoptionsinsider.com. Just be sure to put question for advisors option somewhere in there so we know where to route it. Or just shoot them over to Randy at Swan, and he'll answer them for us and save us a lot of time here on the old program. So no shortage of ways for you guys to get your questions highlighted here, I should say, on the old program. I'm going to kick things off with a frequent writer. This is Mark. He writes, hey, it's fascinating. This is kind of going back to what you were talking about before, Randy. It's fascinating how the Swan process can be condensed to weeklies and succeed for the same reason it does with monthlies. He doesn't out. Clearly, you have a fan, Randy, and now Pat as well of your DRS, as you like to call it. And he's taking it and doing it in a much shorter term time horizon. I have to imagine if he's doing it right, he's putting the short legs in the weeklies. He's not buying a weekly put to hedge, I would hope. But you never know with some of our listeners; they get kind of out there. But what's your take on our listeners taking this and making their own use case out of it, Randy? Is this flattering for you? Are you going to sue him?
No, I love it. I love the concept. I mean, fundamentally, options give people options, right? The possibilities are almost endless in how you want to structure your trade or your portfolio, and so I think that's the best aspect about the whole concept of being able to do this. So I love it, and I think the best thing is that ultimately people get to design strategies based on the way they view things and the way their personality is and the way it works for them. And I think ultimately at the end of the day, that's what will make a successful strategy. If you have a certain view, certain way to do things, and you can design a strategy that's tailored to what you want to do, I think you have a higher probability of being successful at the end of the day. We don't want to look at everything as the way we would do. But no, I love it. It's great.
Yeah, clearly this guy is an active trader, so he has some time to manage it. Maybe some of the advisors out there want to do a little bit more, want to stagger it a little bit more, do monthlies, something like that, to make them make their lives a little bit easier, probably. But you have something you want to add?
So we obviously, we're not going to preclude ourselves from trading weeklies or quarterlies. Mark I'm sure he understands. He has to weigh the benefits and costs. You're not going to insure your house every month. You're going to get as long-term policy as possible, most of us annually. So if it's working for Mark, great. We do look at the weeklies. If we don't trade them, we have to look at them in correspondence and how they relate to the security we might trade.
I mean, they're so popular now, they impact everything else. So much of the liquidity is migrating there. It affects how other options in the chain perform. So you're right, you have to at least pay attention to them and be tangentially aware of them at the very least. Otherwise, you're missing a huge portion of the data that's going up on a daily basis. Next up, we have a question from Alan. He writes, do you feel that fear of generating additional commissions is a reason why so many financial advisors out there don't want to use options? This kind of gets back to what we were talking about before, Randy, with you saying now there's signs at the conference that perhaps that isn't the case anymore, that maybe some more firms are starting to embrace it. But do you think Alan's right? Do you think commissions are the big boogeyman keeping people out of this space?
I think they could be part of the problem, but I think it goes back to what custodian are you using. I think some of the firms that don't use option trading a lot are going to be more expensive, and the ones that want that business that are more competitive offer very competitive pricing. I mean, I can just mention a couple that we use historically. TD Ameritrade's a big partner of ours. They give us very competitive pricing. In fact, we pay asset-based pricing on all our separately managed accounts. So an incremental trade here or there does not cost our clients any more money, and we think that's valuable. That's a selling point for our clients to know that, hey, we're paying a reasonable amount. I can only tell you, you guys were probably trading on the floor when I was sitting there paying these ridiculous commissions in the late 90s, and it's just amazing when I tell people what I used to pay per contract of SPX was like $12, and now it's like $1 with the exchange fees. So obviously the competition, the commissions have come down, but you have to be careful who you use. And quite frankly, I think it's even more important than just the commissions is a lot of the firms really are not supportive of options. So you need to shop a firm that supports what you want to do, because it's not fun, paddling the boat upstream.
That's what I was going to ask you, as kind of a corollary to this question. As you guys have been going around the conference, you mentioned there's more acceptance of options, but one of the big problems, and we've talked about this before, you guys had to build your own software because the tools out there are atrocious for advisors who want to adopt this product class. Have you seen any signs of that so far at the conference? At least, are there tool vendors there? Are there brokers saying, hey, look at our awesome new options platform for advice? Is there anything like that?
I haven't found anything, but I'm not saying it's not here. I haven't actually gotten around to walk around, look at all the different tables. Obviously our business is unique. I think that a lot of the platforms have stuff for your retail investor to be able to do some really unique, powerful stuff. So I wish that stuff existed when I started trading. In fact, I always laugh about one of the things that we're in the process of doing is developing our own proprietary backtesting system that, we always laugh and say, one of the software that we've been using for the last 10 years, I wish I had that when I really started out doing this. So, things are progressing, but as a firm like us, we have to do it in-house.
Yeah, just going back to commissions, it is one benefit, one of the many benefits of growing, having $1 billion fund. You can imagine the commission triggers that we hit where we trade enough contracts. Because of the notional value that we need to invest in the portfolio. And so the commissions will limit towards zero as you scale.
That's true.
And they come out of the returns in the blended products, whereas SMA clients can see them.
Yes. How about here's a good one. This one comes from a listener. It goes by the handle Big Jim. He writes, I've heard you guys recommend against rolling your covered calls, but I'm closing in on retirement, and I've had this stock position for a number of years. It would be a sizable tax hit, this kind of gets to what we were saying before too, if I let it be called away. I also don't want to keep closing and reopening it and generating taxable events. So what should I be looking at when managing my covered calls? What strike should I be writing? How close to the strike should I think about rolling it? This is kind of a perennial question for the covered calls. I was joking with Tom when he was on the show about the covered call guys not wanting the stock to get called away, but it is very much. And you mentioned taxes, that he clearly is tax-driven here, but this also seems to be a mentality with covered call traders. They will write that call, they'll do all their homework, we'll tell them, pick a strike you're comfortable selling the stock at, and yet when it gets even remotely close to that strike, they're rolling, they're locking in the things. They don't want their stock to get called away, even though we tell them, hey, it's a good thing if your stock gets called away. Clearly in his scenario, it's not. He wants to be a little bit more judicious, so I think in Big Jim's case, he probably shouldn't be writing deep in the money calls and trying to go that way. Probably a little bit more judicious on this. Maybe Pat, we'll start with you this time. What do you have to say here for our friend Big Jim? He doesn't want to keep closing and reopening. He's had stock for a long time. Doesn't want to get called away. obviously this is hard to know without knowing his specific scenario, but in ballpark terms, what percent out of the money do you think he should be playing with, and how close, if you were managing that portfolio, how close would it get before you would think about rolling it?
Sure. So first, huge disclaimer, we can't give tax advice. Although Randy, as I'm sure you're aware, has that extensive experience as a CPA and brilliant in all of those areas. So I think that this listener should do the math and decide what the tax hit would be, because his situation seems to be specific. So what is your effective tax rate? Find that out and incorporate that into returns that you are acceptable with from the call. Other than that, we can't really speak to a percent out of the money or give him advice as to where he should set the next call, because obviously taxes are a big deal for him. And if you've held the S&P for the last 6 years, your taxes you could be taxed on 60, 70% of the credit that you collect. So.
Yeah, taxes, indeed, particularly for those covered call guys, a big factor in their trading decision. Anything to add to that, Randy?
Well, I think you obviously, when you engage in short-term covered call writing, obviously that by definition will be a taxable event. You could consider using certain types of contracts to get the Section 1256 contract treatment, like the SPX and the broad indices. So that's one way to get around it. Obviously, this isn't going to help in the particular circumstance of owning a certain stock, but we at Swan, we don't really engage in buying individual securities, and that's one of the reasons why we don't really want that decision of our equity, our ETF exposure is really a buy and hold. We never sell it. We never get called away for that exact same reason. We'd like to minimize taxes. If I was going to break down an individual security, maybe you say you're willing to let maybe a part of that get called away and not do the whole. It doesn't have to be an all or nothing deal.
Yes, that's true. People think of their portfolios in one large chunk, and they don't think of it maybe in manageable sums. I said we got last one. I lied. We got one more here. Might as well squeeze him on too. I'd feel bad if Tom didn't get any. He's a new fan of the show. This comes from Tom. He writes, "I love the Advisors Option Show. I stumbled across it in iTunes last month, and I've been scrambling to catch up." Well, you got a lot of listening to get ahead of you, Tom, so get going. He goes on to write, "You guys have spread a lot of knowledge to your listeners, and I'm working to digest it all. Rather than waste your time with an options question, the answer to which I probably won't understand," he puts in parentheses, "yet." Well, that's good. He's learning. "Let me ask something more basic. Where can I find an advisor in my area that utilizes the practices and strategies you discuss on your program? Is there a database or website I can go to find options using advisors? Thanks, and also please ask Randy why he relocated Swan to Puerto Rico. The weather is certainly nice, but were there other reasons also, taxes, family, etc.?" Well, Randy, you can probably handle that last part first. Why are you in scenic and sunny Puerto Rico, aside from the awesome weather?
Well, I think there was 3 reasons we outlined in our Good, Bad, and the Ugly, which is our quarterly newsletter, I think about a year ago. We moved part of the firm down there. Our operations are still in Durango, Colorado, and we've got a sales office in Tampa. And I think there was 3 reasons. The weather is great, but I love the weather in Colorado. So, it was fundamentally moving down to a new area for 3 reasons. Take advantage of the lower taxes. It allowed me easier travel to the East Coast or the eastern half of the U.S. Flying out of Durango, and I do extensive traveling, is very difficult. Flying from a place high in the mountains that goes through Denver, quite frankly, it's almost like almost guarantee that it's not going to work out during a lot of the months of the year. The third thing is that we, as we've mentioned on the show, we launched a reinsurance company in Bermuda, and tax laws prohibit me helping run the company while I'm in the U.S. So those are the 3 main reasons. I can't remember the other question that he asked.
Well, he wants to know, is there a database for advisors who use options, something along those lines?
Well, look, first of all, if you really want an advisor, we can put you in touch with several advisors that use options. I don't know of a particular database of advisors that use options other than my experience that we obviously have probably hundreds of advisors, if not thousands of advisors that use us, but have them send me some information. I'll put them in contact with someone like that. But regardless of whether or not you contact me or not, I think fundamentally you need to interview the advisor or potential advisors that you're looking at and seeing whether or not it's a good fit. I always go back and say, if you talk to an advisor and he seems kind of reticent to even get into options, or even sounds like he is, but he really isn't, I wouldn't want to go to that advisor. if he wants to use options. You want to use an advisor. You want to ultimately find an advisor that embraces options, has experience in it, and knows the pitfalls of each one of the strategies, when they're going to work, when another strategy may work, to ultimately provide you the most value.
This isn't kind of an issue we've struggled with on the show for a while. You know, I talked to the OCC guys about it, and they would like to do more to highlight that, but they're afraid of, promoting individual advisors. It kind of goes against their mantra. So there's issues with that. There are some database products that I've looked at, and you could filter them by kind of asset class people manage, but those things aren't very complete. And if you search for things like options, you get, like 3 guys on the 30,000 database. So those aren't very useful either. So I feel your pain, Tom. Maybe you should write to Randy, and he can at least point you in the right direction. And maybe some of the stuff you guys are doing with the mutual funds and stuff will be enough for what he wants to do. He doesn't spell out exactly what he's looking for here. If he wants protection, income, maybe a little bit of both. But either way, it is a problem. Something we're looking at ways to maybe address more on this program going forward. In the meantime, reach out to you guys at Swan, because you guys probably have the most hands-on in terms of dealing with the different advisors around the country who actually does this on a regular basis. You can maybe point them in the right direction if what you guys are doing isn't suitable. So great question, Tom. Thanks to everybody who wrote in. We love to hear from you guys. Keep those questions coming. And unfortunately, that's all the time we have for the listener mail segments. Also all the time we have for this episode of The Advisor's Option. It's very special live in-person episode of The Advisor's Option. We don't get to do this very often, so it's fun. And before we go, of course, I want to thank Tom, who had a chance to join us on the program, and Randy and Pat. Pat, of course, thanks to you for coming on the program as well. Really quickly, we kind of hit on all the stuff you guys have coming up. Anything else you want to leave our listeners with? Any hints, any teases of what's coming down the pike over there at Swan that may interest them until the next time we can all gather together here?
Well, I think I mentioned this, that we are getting ready to publish our most recent version of The Good, Bad, and the Ugly. I think it's going to be sent out on Monday and put on our website. So that gives a good brief description of what's going on at Swan and what we think is happening and important, and giving a discussion of the industry in terms of options. So it's a good read.
Great. All right. Well, Randy and, of course, Pat, thanks for joining us. And thanks to all of you guys who wrote in. Keep those questions coming. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.